and welcome to episode 22 of the Special Situations Report, a podcast by Inside Arbitrage covering the most intriguing event-driven activity over the past week. My name is Asif Suria, and I'm coming to you from the beautiful San Francisco Bay Area.
And my name is Tamanna Suria, and I currently attend the University of California, Los Angeles.
On this podcast, we will discuss the appointment of a new CEO at Shift4 Payments, shareholders voting down a very large pay package for Warner Brothers Discovery's CEO David Zaslav, a non-binding proposal by Merck to acquire MoonLake Immunotherapeutics, a highly unusual insider purchase at a company that is currently being acquired by Novartis, an insider purchase by a long-serving director of Topgolf Callaway, and a whole lot more.
Before we begin, it's important to state that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data provided in this podcast. Nothing discussed in this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions.
If you have been enjoying this podcast, do us a huge favor and take a moment to like, subscribe, or rate this podcast on whatever platform you might be listening on. So this week we're flipping the script a little bit, and instead of starting with M&A and ending with C-suite transitions, we are instead going to discuss some C-suite transitions first, especially in light of the very public breakup of the bromance between Elon Musk and President Trump last week.
The payments technology company Shift4 Payments announced that its CEO, Jared Isaacman, was stepping down effective June 5th. When Trump first got into office, he nominated Mr. Isaacman to head NASA, and Mr. Isaacman managed to get through the confirmation process with support from both Democrats and Republicans.
However, Mr. Isaacman's political stint ended even before it began. President Trump withdrew Mr. Isaacman's nomination on May 31st, just days before a Senate vote. During the public showdown between President Trump and Elon Musk, Trump revealed that it was Elon Musk that internally championed the appointment of Mr. Isaacman to the head of NASA. Trump went on to claim that a thorough review of Mr. Isaacman's prior associations, he determined that Mr. Isaacman was a Democrat.
We don't know if this is one of the sticking points between Musk and Trump, but after Elon started to post repeatedly about Trump on X, following his disapproval of Trump's big and beautiful spending bill, Trump mentioned that one of the ways to save money would be to stop giving Elon's companies like SpaceX government contracts, which are estimated to be as much as $22 billion, most of which have come in the last 5 years.
Clearly, having a close ally like Mr. Isaacman heading NASA would have helped solidify the NASA and SpaceX relationship further. Getting back to Shift4 Payments and C-suite transitions, the new CEO Taylor Lauber is an internal promotion. He was previously the president of Shift4 Payments for over 7 years. Mr. Isaacman will continue to be involved in the company as its executive chairman, so it's good to see that the founder isn't entirely leaving the company, but it might not have the same momentum that it did under Mr. Isaacman.
We first looked at Shift4 Payments in the first place due to insider purchases by Jared Isaacman, so I'm curious to see if he'll continue to purchase shares even though he's not acting as CEO anymore.
Yeah, it was a very well-timed insider purchase, and we wrote about it and we liked it quite a bit back then. We should have acted on it and bought the stock as well.
Absolutely. Moving on to another C-suite related story, David Zaslav's pay package at Warner Bros. Discovery was rejected by shareholders, with 60% of shareholders voting against his more than $50 million pay package, which was a 4% increase over the prior year. For once, someone stood up to his elevated pay package, but unfortunately the vote is non-binding, so it won't really make much of a difference.
Yeah, shareholder advisory firm Institutional Research Service, or ISS as it is more commonly known, also recommended a no vote on his pay package, as CEO Zaslav's pay package was higher than what Bob Iger is paid at Disney, as well as the CEO of Comcast. The stock was down 4% in 2024, and over the last 5 years is down more than 60% following the disastrous merger of Warner Brothers with Discovery.
Zaslav's pay package also made the news in 2021 when it was reported that he was going to be paid $246.6 million due to options grants related to a contract extension. This pay package was going to get paid out over several years. Companies are now required to report a pay ratio, which compares what the CEO gets paid compared to the median worker. In Zaslav's case, it was 398 to 1.
Wow, so he's going to get paid 398, almost 400 times what the median worker makes at Warner Brothers Discovery. I wrote about pay ratios in my book, The Event-Driven Edge in Investing, when I mentioned Intel's ex-CEO, Pat Gelsinger, as a case study. His pay worked out to an astounding 1,711 times the pay of the median worker at Intel. This rich payout was supposed to happen over several years. In a paper called Spinning the CEO Pay Ratio Disclosure by Professor Joshua White and other collaborators, the authors discuss how companies with very high pay ratios attempt to spin things in a positive light, lest this public knowledge impact company and employee morale. They found that in the second year, high ratio firms are more likely to lower their reported ratio by altering the selection of their median employee. So instead of actually bringing down these egregious pay packages, they were messing around with how they figure out what the median employee is making. A combination of a very high pay ratio and a management team that is remote can be a very big red flag for investors.
Moving on to the last C-suite transition for this episode, a while back we talked about Dollar Tree selling their Family Dollar chain to the PE firms Brigade Capital Management and Massillum Capital Management. Dollar Tree and many other discount retailers have faced difficulties over the last few years due to online competition from Shein and Temu and rising prices across the board, which were only exacerbated by the recent tariffs.
We are breaking this whole thing up because the last C-suite transition we want to discuss is the sudden departure of Christy Chipman from her position as CFO at the discount retailer Five Below. She had been with the company for a little over under 2 years, and the stock was down over 38% during her tenure.
Five Below also lost its CEO last July, a role that was only filled in December 2024, about 6 months later, by Winnie Park. Miss Park came over from Forever 21, where she previously served as the CEO. Given that Forever 21 went on to go file for bankruptcy a couple months later, the C-suite transition there doesn't really excite me much, but the recent performance of Five Below does.
Yeah, retail is such a difficult segment to invest in. Unless you're investing in Costco or Walmart, for the most part, it's hit or miss. Surprisingly enough, after a few weak quarters, Five Below reported strong first quarter earnings despite the tariffs, growing revenue by 19.5% and net income by 30.8%. This beat analyst expectations and earnings estimates across the board, which likely contributed to the nearly 55% rise in the company's stock over the last month after an initial decline after the tariffs were announced.
Moving back to regular programming, let's dive into some rumored deals, or as we like to call them, deals in the works. The pharmaceutical giant Merck has held talks to buy the Swiss biotechnology company MoonLake Immunotherapeutics for over $3 billion. Just to clarify, this is the American Merck, not the German Merck, and we last talked about the company in episode 18 when discussing insider purchases at the women's health company Organon, which was spun out of the American Merck in 2021.
Back to the potential deal at hand, Merck has submitted a non-binding offer for MoonLake earlier this year, valuing the business in excess of $3 billion. MoonLake rejected the initial approach, but recent rumors have indicated that talks have revived. MoonLake is focused on dermatology and rheumatology. And while it is still a clinical stage company, it has a number of drugs in phase 3 trials to treat a range of conditions.
As for current deal updates, a group of US senators, including Elizabeth Warren and Bernie Sanders, are trying to block the Redfin and Rocket Companies deal we talked about a few episodes back. However, considering the waiting period under the HSR Act has already expired, and antitrust regulators have essentially cleared this deal, it's unlikely that this recent move will have much of an impact on the deal. Just a day after this news, Redfin shareholders approved the deal, which is now set to close on July 1st, 2025.
It's interesting to see how Elizabeth Warren and Bernie Sanders often step up and talk about these deals that are on consumers' minds because they're consumer-focused companies in some sense. Moving on to recently announced deals, this is shaping up to be a biotech week. Sanofi is set to acquire Vigil Neuroscience, which, as the name implies, is a biotech company focused on neurodegenerative diseases in a $470 million deal. Under the terms of the agreement, Sanofi will acquire all outstanding common shares of Vigil for $8 per share in cash. In addition, Vigil shareholders will receive a non-transferable CVR for each Vigil share, which will entitle its holders to receive a deferred cash payment of $2 per share, conditioned upon the first commercial sale of its drug, VG3927.
VG3927 is a phase 1 small molecule drug meant to treat Alzheimer's. Similar drugs have been developed and approved by the FDA and are made by Eli Lilly and Liquembi, which is a joint venture between Biogen and the Japanese pharmaceutical company Eisai. However, the small molecule nature of VG3927 is what sets it apart. Vigil Neuroscience does also have another flagship drug attempting to treat a fatal neurodegenerative disorder known as ALSP. The drug is currently in a phase 2 proof of concept trial, so it's interesting to see that the CVR isn't connected to this therapy, which is arguably further along in development than VG3927.
That's interesting. Vigil is currently trading at $7.88, meaning that the CVR appears to be almost a free lottery ticket. Considering just how long it takes for a drug to reach its first commercial sale, especially given that it's still in phase 1 trials, this is perfectly understandable. Moving on to a new deal, Viper Energy, which is a subsidiary of Diamondback Energy, is set to acquire CTO royalties in a $4.1 billion deal, and it's set up as an all-stock deal. The oil and gas royalty companies often tend to do better than the exploration and production companies, and also often tend to have a very high dividend yield. We had previously discussed Diamondback Energy in a podcast in February after its long-serving CEO decided to step down. I had started a position in Diamondback a few years ago after seeing the company's disciplined capital allocation strategy and sold the stock shortly after the announcement of that CEO departure. In our February podcast, I mentioned that I always found it amusing that the companies that were spun out of Diamondback Energy were given the names of snakes as well. So 2 of these spin-offs were called Viper Energy Partners and Rattler Midstream, and it is this spin-off, Viper Energy, that is now merging with CTO royalties.
I wonder if we'll get another snake-related name.
That'd be interesting if that happens.
Absolutely. Continuing on, in one of our earliest episodes, we discussed NB Bancorp, or NBBK, in quite some detail, going over thrifts, aka mutually owned banks, thrift conversions, and the typical thrift conversion playbook, which includes repeated insider buying after going public, share repurchases, and then eventually getting acquired. In fact, 70% of thrifts get acquired by larger banks about 3 to 5 years after their thrift conversion. The moment that NBBK went public, we started to see insider buying at the company, and then almost exactly a year after the conversion, NBBK announced its first buyback, once again following the typical thrift conversion patterns to a T. However, this week I was quite surprised to see that NBBK had announced plans to acquire Provident Bancorp in a deal valued at around $200 million. So rather than NBBK being the one to be acquired, it's acting as an acquirer, which is quite uncommon.
Maybe they just want to expand their assets before they're eventually acquired by some other bank. We have, I think, over 4,000 regional banks in the US, and consolidation has been going on for years and will likely continue. This deal is a cash or stock deal where Provident shareholders can receive 0.691 shares of NVBK common stock or choose to receive $13 in cash. But the allocation is such that 50% of the Provident shares will be acquired via the stock consideration. So it depends on how the proration might play out. You should probably plan for half stock and half cash.
Right. And just adding on to what you said, while this roll-up doesn't exactly mean that MBPK won't be acquired after 3 to 5 years, I'm curious to see what exactly an impact this will have on the company and its future acquisition prospects.
Got it. Let's talk about the last M&A deal from last week. By no means is this a comprehensive M&A overview. We cover that both on the Special Situations Report as well as Inside Arbitrage. But the biggest new deal last week was the merger of Chart Industries with Flowserve in a nearly $11 billion all-stock deal that is expected to close in the Q4 2025. Chart Industries manufactures engineered equipment for the energy and industrial gas sectors with a focus on clean energy solutions such as LNG, hydrogen, biogas, and carbon dioxide capture.
On the other hand, Flowserve provides pumps, valves, seals, and flow management services for industries like oil and gas, power, water, and chemicals across more than 50 countries.
Switching gears now to spin-offs, things have been generally quiet on the spin-off front, but we can briefly talk about a spin-off that was announced last December, which is Switzerland-based building solutions company Holcim announced last December that it was going to spin out its North American business and call it Amrise. Shareholders approved the spin-off last month, and considering that they want to complete the spin-off in the first half of 2025, it'll most likely happen this month. The spin-off will be listed both in the US and the Swiss Stock Exchange, and the ticker will be AMRZ.
Moving on to our buyback section, Autoliv, which is an auto safety systems company that develops, manufactures, and supplies airbags, seatbelts, steering wheels, and more, just announced a $2.5 billion buyback, representing a whopping 31% of the company's market cap at announcement. Autoliv last announced a $1.5 billion buyback in November 2021, which represented about 5% of all shares outstanding at the time. And it's good to see that the company has followed through on these announcements. Over the last 3 years alone, Autoliv repurchased about 11% of all shares outstanding.
This buyback activity and this latest announcement kind of reminds me of AutoZone, which along with NVR has been known as to be a big share cannibal, if you will. Autoliv also pays a dividend with a forward yield of 3.22%, and the forward PE appears cheap at just under 12, but the company, as expected, has fairly low margins at around 19% gross margins and 6.63% net margin. Growth has stalled recently, and the company does have a fair amount of debt on its balance sheet, which makes this decision to do a large buyback even more surprising.
Another buyback that we wanted to cover was at the company Sprinklr, which unfortunately is not a garden sprinklers company or an ice cream toppings company, and is instead a cloud software business that does exactly what its ticker CXM suggests: customer experience management. Sprinklr just announced a $150 million buyback, representing 6.42% of its market cap at announcement. As expected of a SaaS software company, gross margins are high at around 72%, but net margin surprisingly is 15.27%. The company does have net cash on the balance sheet, but stock-based compensation isn't insanely high, it's somewhat moderate, so the share repurchase announcement does make sense.
Switching gears to what I think is one of the most fascinating stories this week, it has to do with insider transactions. And the first insider transaction we want to discuss continues with the general biotech theme we've been seeing throughout this episode, and was one that gave us a sense of déjà vu. Preston Klassen, the president and head of R&D at biotechnology company Regulus Therapeutics, purchased 12,000 shares of the company for a total of $96,000.
Such a tiny purchase at a clinical stage biopharmaceutical company would normally be something that we pay little attention to. But the reason why this purchase stood out to us so much is that Regulus is in the middle of being acquired at the moment. At the end of March of this year, Novartis announced that it is set to acquire Regulus for $7 per share in cash, and a contingent value right that could pay out an additional $7 per share.
This CVR or contingent value right is set to be paid out following the FDA approval of Regulus's flagship drug, farabursen, which is meant to treat autosomal dominant polycystic kidney disease in human patients. In order for the CVR to be paid out, the drug must be approved by December 31st, 2034.
Farabursen is currently in Phase 1, but following Phase 1b data from this March, a Phase 3 trial is set to begin by the third quarter of this year. Understandably, Novartis was not alone in trying to acquire Regulus. During the go-shop period of this deal, 17 parties engaged in discussions with the company. The original deal with Novartis was for $3 per share and then a $1.50 CVR, but another undisclosed party, referred to as Party A, began a bidding war, which drove the deal price up to where Novartis eventually emerged victorious, offering the $7 per share and then the $7 CVR.
That's quite a bump up from the original discussions, and I think we should point out that this was not a go-shop period after the deal was announced, but probably the competitive bidding period that happened before a definitive merger agreement was struck. But the most unique thing here is that the only other time we've seen insider buying in a target company in the middle of an acquisition was with Biohaven, which is why we felt this sense of deja vu. So when it came to Biohaven, I remember right before the deal closed, there was a director, and if I remember his name correctly, it was Gregory Bailey, who bought shares for $148.04. And I think the cash part of that deal was $148.50 back in 2022. He was buying Biohaven not for that 40 or 50 cents spread on the deal. He was buying it because Biohaven was going to spin out its pipeline of drugs that Pfizer did not want to acquire into a new company, also called Biohaven. And it was the value of that spin-off that this insider saw and wanted to buy before the deal closed. So this situation seems to be very similar to the Biohaven situation, where it's the head of R&D that wants to pick up shares before the deal closes. And he's essentially betting 99 cents on a potential payout of $7 in the future.
So fascinating situation all around. Moving on, another set of insider purchases that drew our attention was a cluster of insiders buying shares of Topgolf Callaway last month, including the CEO, the president of the Callaway Golf Division, and a director. Last week, we saw a significant purchase by a director who purchased nearly $2.5 million worth of shares.
Director Adebayo Ogunlisi joined the board of Callaway Golf in 2010, long before its merger with Topgolf in 2021. The merger didn't quite work out the way the companies expected, and they're currently in the process of divorcing with each other, with the spin-off of Topgolf expected to be done sometime in the second half of this year. Mr. Ogunlisi has an interesting background. After a bachelor's degree from Oxford and both a law degree and an MBA from Harvard, he began his career as a law clerk for U.S. Supreme Court Associate Justice Thurgood Marshall. He was a senior managing director at BlackRock and is now the CEO of a PE firm focused on infrastructure investments called Global Infrastructure Partners.
This is only the second time that he has purchased shares of Topgolf Callaway. The first time was a $2 million purchase in June 2023, and the second time was last week. The timing of the first purchase was not very good, but hopefully he has it right this time. Now, the last insider transaction we wanted to highlight was a series of purchases at the land company, Maui Land and Pineapple. The purchases were tiny, but we figured that they were worth mentioning because of who Stephen Case, the insider who was buying, was. At the height of the dot-com bubble, Mr. Case spearheaded the merger of AOL with Time Warner, having been AOL's CEO, which history doesn't look upon too kindly. Investors have widely regarded it as one of the most unsuccessful mergers of all time, especially following the burst of the dot-com bubble and the massive losses that ensued for the combined company shareholders. However, AOL shareholders got a nice payout, whereas existing Time Warner shareholders were left behind with this new combined company.
Yeah, it was this fear of missing out, of FOMO, where everybody, the old media companies, wanted a piece of the internet revolution and ended up triggering this merger of AOL with Time Warner. Moving on to Mr. Case, he went on to found the investment firm Revolution, which he seems to have had a lot of success with. One of Revolution's key investments was in Zipcar, which went public in 2011 before being acquired by Avis Budget Group in 2013. Even after Zipcar went public, Mr. Case continued to purchase shares on the open market at prices of around $7 per share, and I recollect seeing these insider purchases in 2012, if I'm not mistaken. And that worked out very well for him, considering that Avis acquired Zipcar for $12.25 per share.
Mr. Case's current purchase of Maui land and pineapple are his first purchases of the company since 2013, where he was buying shares in the $3 to $4 range. He is the largest shareholder of the company, having been both born and raised in Honolulu, Hawaii, so lots of ties to the state, and he actually owns tens of thousands of acres of land in Hawaii, mostly via Maui land and pineapple, but also through his ownership of the Grove Farm of Kauai.
I wonder if that fire that was impacting Maui a year or two ago had an impact on the land that Maui Land and Pineapple owns. You know, we were talking about earlier going to Oahu to check out one of the park hotels, resorts. So we should probably do that and then pop on over to Maui to check out this company as well.
Sounds great. But I do think he made like a $1 million donation following the Maui fires. He issued a press release about it because I do think it impacted the land he owned in a significant way.
Absolutely. It was a devastating fire, kind of like the wildfires that you experienced last year, or was it earlier this year?
Earlier this year.
Near UCLA. It's been devastating to see the impact these fires have had.
Absolutely. And with that, we will wrap up episode 22 of the Special Situations Report. As always, what we've covered today is a brief overview of the special situations landscape. So if you'd like to access a more comprehensive weekly overview of all event-driven activity, go ahead and visit our website, thespecialsituationsreport.com, for daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities, such as a merger arbitrage tool. Go ahead and check out insidearbitrage.com.
And if you enjoyed this podcast, please take a moment to like and subscribe on whatever platform you may be listening on, and especially share it with your friends who are interested in special situations. Thank you.